What's going on, everybody? Tiger here. Hope you're doing well on this lovely Friday. TGIF, we have made it. Okay, so hey, just to kind of recap, I went through a video a while back, 30,000 foot view, talking about fundamental analysis, sentimental analysis, technical analysis of the markets, so that we know how to decide what to buy and sell in the markets, whether that's forex, gold, stocks, options, orange juice, anything, okay? We got to know all that stuff. We can't just blindly throw mud on a wall and see what sticks, okay? We got to have a reason why to buy something, but a reason why not to buy something. So, my first video in that series did cover sentimental analysis. I released that, I believe it was this past Friday. So, if you haven't seen it, go check it out. That's going to be one of the most important things to know and understand. That's the green section right here, number 1 and number 2 on my little cheat sheet, my order of operations. So definitely go check that out. It's about 20 minutes, but it's very, 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 very important to understand. So that's fundamental analysis. So beyond that, this video is all about sentimental analysis. So we're going to look at number 3 and number 4 here. I don't think this video will take as long as the last one did, so let's just jump right into it. What the heck is sentiment? Well, it's just simply where people think the markets are going to go, okay? So if they're a smart trader, if they're a smart investor, they're going to look at the fundamentals, and based off of that, they're going to have their own sentiment, their own feelings, their own thoughts. Okay, on a whatever the instrument is they're wanting to trade. So it's really just a matter of formulating your opinion. Now we've got retail sentiment, which again is just all the everyday regular Joe traders, Jill traders, sitting on your computer, your laptop, whatever. The dumb money they call us. Okay, not my term, that's theirs. It's been around forever. Okay, you got smart money and you got dumb money. So if we're technically the dumb money, who the heck is the smart money? Well, that is the financial institutions, the big banks, pension funds, all that kind of stuff. Okay, remember, we're trading small amounts of money relative to what they're trading. We're trading maybe a few $1,000, maybe 20,000, maybe 50,000. Okay, that's small potatoes. They're trading millions, hundreds of millions, and even billions of dollars, the smart money, the so-called smart money. So we're just going to break that down real quick, but I'll jump right straight into number 3, which again is about retail sentiment. Well, what the heck is that? Well, there's 4 different, I'm sorry, I can't count today. There's 3 different retail sentiment reports I like to look at to decide if I'm going to have something on my watch list, okay? We got retail sentiment, we've got the put to call ratio, and we've got the AAII investor sentiment. That stands for American Association of Individual Investors. Okay, so let's just jump right into that first one, retail sentiment. I'm going to flip on over here to a website that I use to get all this information. Okay, this is a1trading.com. Really, really powerful tool. I'll actually probably make a video about this tool all by itself at a later date, but for now I'm going to use it to kind of go through the sentimental analysis. So if we look right here, market sentiment, the first item there is the retail sentiment. So what am I looking at here? Well, this is the real-time data of all the positioning for retail traders. So just as an example, I've got selected here the major currency pairs, okay? Now that obviously pertains to the US dollar, the Swiss franc, the New Zealand and Australia and Canada dollars, okay? All 3 of those currencies are the dollar. And then the Japanese yen. I think I listed them all. And then the euro and then the British pound, of course, okay? So that's the main currencies I like to trade. Why? Because they are very, very liquid. I can get in and out of a trade in microseconds, okay? That's why I like to trade those. Quick in, quick out, very tiny little slippage. Okay, that's again, that's more stuff for another video, but they're very popular currencies to trade, and this is what the big banks trade the most of as well. So me being a retail trader, I want to follow what the big banks are doing. Remember, I said ride their coattails. Having said that, retail traders, we all have our own mind made up where our currency is going to go. We get in there and we buy something. At the very top, you see the United States dollar, Swiss franc. Okay, it's called the Swissy. So the average retail trader has a 74%, I should say 74% of all retail traders have a long position, meaning they think price is going up. So they've bought with anticipation of price going up, to only 26% of them thinking it's going down. Okay. So that is a very popular, at this moment, trade that retail traders have. They think it's going up. Okay. And then if we kind of go down here lower in the list, the very bottom, we got the British pound US dollar pairing. Okay. So they're the opposite. Looks like 69% of all retail traders that are in that position have a short sell position, meaning they want price, they think price is going down. And only 31% think it's going up. Okay. So they've got their own reasons. Maybe they threw mud on a wall to see what's going to stick. Maybe they did look at some of this good fundamental and sentimental analysis to make an educated guess. Look, all trading is educated guesses. It's formulating a hypothesis based off of all these economic indicators. So right or wrong, that's the decisions made right there. That's the retail positions. And then, of course, you can see the various percentages for the other major currency pairs. Now, we're not even talking about the minor currency pairs right now, where you mix and match euro and British pound as an example. This is everything that has the dollar, the US dollar, in it as a currency pairing. So that's it. Now, what's one of the main takeaways? Why the hell am I showing you this? Well, if we know that 90% of traders lose 90% of their capital within 90 days of opening their account, then what's a good idea? Observe the masses and do the opposite. So if the retail population thinks that the US dollar up there at the top is going up, well, we might consider looking at that as a contrarian and taking it the other way. So rather than buying with the crowd, we want to go against the crowd and short sell that. Okay, that's as simple as that gets with respect to the retail sentiment. So it's not to pick on the retail crowd. It's just the reality of how economics works and supply and demand. Okay, the average trader, the average investor doesn't know what the heck they're doing. Okay, we as a human species, we tend to follow the herd. It's called the herd mentality, right? Well, in trading and investing, that's not the right thing to do because you're going to lose your behind. Okay, so that's retail sentiment in a nutshell. Now I want to flip on down here to another sentimental analysis report. It's called the put to call ratio. What the heck is that? Well, this is the options trading market. Okay, and I can obviously flip it up here. At the moment, we've got the S&P 500, and we can look at anything. I mean, oil, silver and gold, the NASDAQ, the Nikkei in Japan, Russell 2000, so that's 2,000 of the smaller companies, right? The DAX in Germany, China 50 there, the Dow Jones, okay? Basically, if I flip to any of these, it's going to show me, especially the indices, that's what I care about at the moment. It's going to show me how many people, it's going to show me the ratio of puts to calls. Well, what's a put and what's a call? So in options, if you buy what's called a put, then you're expecting price for that instrument to go down. Well, what does that mean? If you buy something, you want it to go up, right? Well, it works a little different in the options market. I'm not going to get into it in this video because that's a whole entire video series, and I'm not an options trader, so I'm not even going to pretend to be able to understand it. But the basic idea is this is a very similar report to look at and kind of compare it to the retail sentiment, which we just looked at. Basically, in a 2 sentences, all we need to worry about is this. You see right here, extreme fear, okay? So if this white line is above the blue line, that means there's fear in the markets. That means there's people buying buying puts, okay? They're buying puts, meaning they think the market's going to go down, all right, like I said earlier. If they're buying calls, if it's below that red line, that means they think prices are going up. So this is very similar. We observe the masses and we do the opposite. At this very moment for the S&P 500, You got a lot of people. You got the average investor, on average, buying puts. So that means they think the S&P 500 is going down. Okay. So we observe the masses. We do the opposite. If I were a stock trader, or an index trader of the S&P 500, even though I see the average person thinks it's going down, I'd be going to buy up. I want price to go up. So it's going against them. Okay. It's kind of a dog eat dog world. That's just the way it works in trading. I didn't write the rules. I just learned how to follow them. Okay. And then obviously the reverse. If like I said, if price were below the red, that means the average person thinks, collectively, I should say, collectively, options traders thinks price is going up, and we, as the contrarian, would want to sell. So that's the put call ratio. And then the last one, the AAII investor sentiment. Like I said, that's American Association of Individual Investors. It's another sentiment. It's another vote, if you will. Okay, a poll that they take weekly, and to see is the stock market going up over the next 6 months, or is it going down over the next 6 months, or is it staying sideways? So we can see right here, the last 5 different weeks, you can see that the average investor thinks that the stock market over the next 6 months is going down. See, we got 60% right there on February 24th, okay, to 57, to 59, to 58, to 52. So anything over 50, they think the stock market's going down. Again, this is another contrarian indicator. We can look at that and say, if you think it's going down, we're going to take the other side of that trade. We're going to buy where you're selling. Okay. So listen, it sounds like dog eat dog, and that's exactly what trading is. If you ain't comfortable with that, you won't enjoy trading. That's just the reality. Okay. Every time a order is placed, there's a winner and there's a loser. Somebody is buying that instrument to go up. There's somebody on the other side of that wanting it to go down. Somebody will win, somebody will lose. That's just the way trading works. But it's relevant. It's necessary. What's the purpose of trading to begin with? Why is Forex trading, like me, like what I do, why is that important? Most people look at that and think, oh, that's just a video game. It's stupid. What's the point of it? Well, I'll tell you what the point of it is. The point of trading is to balance out the equilibrium of supply and demand. You have to have buyers and you have to have sellers, which a buyer and a seller equals a market. Without buyers and sellers, you don't have a market. You got extreme inflation. You got extreme deflation. Okay? You got to have buyers and sellers to balance that equilibrium out to keep the worldwide markets going forward. That's the purpose. It's not, we don't do it just to play video games, okay? There's actually a real good reason why we exist, period. And it's to balance out the relationship of supply and demand. So anyway, sorry about that tangent. But yeah, there you go. That's 3 retail sentiment reports. Now the final report, okay, so we just did number 3, right? Now we're going to do number 4, and then we'll be done. I told you this video should be a little bit shorter than the last one. So look at Forex COT data to see where the big banks and institutions are positioned. And then I put bar chart there. That's one of the sources I use. But anyway, this is the smart money. Okay? So remember up here, dumb money. Down here. Here, I'm just going to get rid of bar chart because that's just one of my sources. Smart money. Okay? What the hell is a COT report? That's the commitment of traders. This is showing where the big banks and institutions are positioned. So I'm going to go back to my edge finder here. Again, this is a1trading.com. That's where the source is. Okay? Really, really awesome product. So I'm going to close the market sentiment. And I'm going to, up here we got institutional positioning. So we got COT data. Let's open that up real quick. And there's another website that you can find this on. It's called bar chart. Okay, this is another place where you can find the institutional positioning. So I just want to go back to mine real quick. Here we go. Okay, what the hell is this? So this is very similar to the retail sentiment, except this is showing the current positioning for the smart money. Okay, so if we look up here, I'm just going to, yeah, we'll just do this. So from the left to the right, this is institutions shorting or selling those instruments, and then the farther right we go, the opposite is true. That shows what the big banks and institutions are buying the most of, or are positioned in the most. Okay, so if we look all the way at the far left, CHF, that's the Swiss franc, just as an example. So institutions, if you can see there, are short 90%, 90.39 to be exact. That means 9 out of 10 big banks and institutions, 9 out of 10 are short. They think that the value, the price of that instrument is going down to only 10% in the opposite. Okay. So what's the huge difference between the institutional sentiment and the retail sentiment? What is the biggest difference here? The biggest difference is on retail, we observe them and we do the opposite because it's a contrarian signal. On institutions, and again, this is what's called a non-commercial report. So this specifically is those institutions. We want to see what they're doing and ride their coattails because they're the ones that make all the money. If they're the ones making all the money and have the power to move money, wouldn't it make sense to learn what they're doing so that we can do what they're doing? That's essentially all trading is when you look at it in a deeper level, okay? Is just find out where the big money is going and jump on their coattails and ride that sucker, okay? So when they're short selling the Swiss franc, okay, and then there's Canada dollar, there's Aussie dollar to the right of it, there's New Zealand dollar, and there's US 10T, that's the 10-year treasury, okay? That's just that's the main five they're selling at the moment. If they're shorting the Swiss franc, well, we want to do that too, if we find a good place on a chart to do it. On the other end of the spectrum, okay, we got gold. So right now, gold is huge. Okay, we got all this uncertainty going on with tariffs, with all the economic reports and uneasiness we have in the world. Okay, politics aside, that's not important. What's important is reading the raw data and figuring out a place to buy and sell something. So right now, gold is getting a huge boost because of that. We see that from the chart. Okay, so if we go down here, so this is just overall positioning. Okay, I want you to understand that. If we go down here to latest COT buys and sells, okay, this is just what's happened within the previous week. This, for me as a trader, and I'm not an investor, I'm a trader. What is that? What's the mean? What the hell is the difference, Tiger? Investors throw money into an account, they put on a position, and they might set it. It might go for months, maybe even years. That's a long-term investor. When I place a trade, I'm in it for hours to a few days, maybe a week tops. That's a trader. That's a short-term trader, okay? If you're a long-term investor, this line up here matters more. If you're a short-term trader like me, this down here matters more. What does this mean? Well, let's look at the first instrument there, euro, okay? That's the euro from the Eurozone, okay? That's their currency. There are several countries there that are part of the Eurozone. They all collectively use this one currency. Okay, so what this is simply showing is what has happened this past week relative to the overall positioning. So all I care about here is where's the net percentage change? This spot right here. Okay. Well, right now it's showing that the euro gained 7.5% more long positions compared to the week before. Okay, that means that the institutions bought a lot of euro. So they might have done a combination of bought more longs, and maybe they closed out some short positions. Okay, there's a combination there, but at the end of the day, all that matters is the number, net positive or net negative. So you can see right there, longs, they're long 59%, they're short 40%. Okay, so last week, they added 305 long contracts. Now, this is the futures market, okay? So they had 305 long contracts, but they sold 46,000 short sales. I should say they bought back. They bought to cover, right? So when you add, did I say that right? Short contracts, long contracts. Hold on one second here. Long contract. Yeah. So they added 305 and they got rid of 46,000 shorts. Okay. When you add all that up, it was a 7.5% increase. So that means they bought the euro relative. If we go to the opposite end of this spectrum, look at that, US dollar at the very bottom of the list. Look over here to 12.57. They sold 12.5%. They got rid of 12.5%. Okay. We see here long contracts. They got rid of 4,300 long contracts, but they also added 5,300 short contracts. Okay, it's big. That's big percentage. So just looking at this one report by itself, let's put the dollar and the euro. Let's put that into a currency pair, euro dollar. Okay, that means that might be a good potential currency pair to buy. So I'm buying euros, selling dollars at the same time. That's an idea right there. Okay. So by the time you add in the institutional buys and sells with the retail investment to see the difference and see what both are doing, that's its own analysis group, sentimental analysis, to add to the fundamental analysis, to add to the technical analysis on the charts to find a good place to buy or sell an instrument. So I tried to explain that as simply as I can, but if you get confused, just rewatch this. But the bottom line is this, guys and gals. So far, we've learned fundamental analysis. We've looked at all the different reports as far as GDP, home sales, unemployment rates, CPI reports, the inflation report, interest rates. When we have positive reports for our currency pair, if you have several of them, that's a good indication you might consider buying that currency. The opposite is true if you have a lot of them going down or that did not meet expectations. Okay, that's fundamentals. We just went through sentimental analysis. We want to follow the big banks. We want to do the opposite of what the retail crowd is doing. We add that in with the fundamentals. And then on the next video I'm going to get into technical analysis. So this is where we're going to look at some charts. And when we look at charts, this is where we'll start putting all the pieces together, all the puzzle pieces, okay? So if you have any thoughts on that, if you have any questions, let me know. If you got value out of this, please like, share, subscribe. It's Friday. I got to get the heck out of here. I'll talk to y'all on the next video. Peace.